Hey everyone, in this video we're going to be going over Alphabet stock, ticker GOOG or GOOGL, their Q4 2021 earnings, their recent announcement of a 20-to-1 stock split. But before we get into the details and how the stock performed, if you could smash the like button, it really helps the YouTube algorithm. And if you haven't subscribed to the channel, please subscribe. Now let's get into it. So Alphabet starts their earnings report off with a comment from Sundar Pichai, the CEO of Alphabet and Google. He said that our deep investment in AI technologies continues to drive extraordinary and helpful experiences for people and businesses across our most important products. Q4 saw ongoing strong growth in our advertising business, which helped millions of businesses thrive and find new customers. A quarterly sales record for their Pixel phones despite supply constraints, and their cloud business continuing to grow strongly. The CFO of Alphabet went on to say that the fourth quarter revenue of $75 billion was up 32% year over year. It reflected broad-based strength in advertiser spend and strong consumer online activity, as well as substantial ongoing revenue growth from Google Cloud. Our investments have helped us drive this growth by delivering the services that people, our partners, and businesses need. We continue to invest in long-term opportunities. Now let's get into the numbers. So when it comes to revenue, in Q4 of 2021, Alphabet did $75.325 billion. This was a 32% year-over-year growth in the quarter versus $56.898 billion in 2020's Q4, and that was already a 23% year-over-year growth. So going from 23% to 32% year-over-year growth is not only just high growth, it's accelerating the growth rate. And that is extremely impressive when already having such a high revenue number to begin with. When we're looking at the year over year for the entire year ended, 2021 had an entire year of $257.6 billion. This is up 41% year over year. In 2020, the total revenue was $182.5 billion. That was a 13% increase year over year in revenue versus 2019. So the increase from 182 to 257 billion is massive. This 41% year-over-year growth is really just mind-blowing, to be honest. Now, when looking at the operating income, this quarter had $21.8 billion of operating income. That was a 29% operating margin on the revenue. That is increased over a year ago's Q4, which had $15.6 billion of operating income with a margin rate of 28%. So the margins are getting better with scale. Year over year, the entire year ending December 31st for 2021 had operating income of $78.7 billion. This is up from $41.2 billion, so a huge increase in operating income. And the operating margin for the entire year ended at 31%. This is a big increase over the 23% operating margin in 2020. Now, Alphabet breaks down the revenue so we can see how the individual businesses are going. Google Search and Other was $43 billion of revenue, up from $31.9 billion in the quarter. YouTube ads at $8.6 billion in revenue now, up from $6.8 billion a year ago, so amazing growth at YouTube. Google Network at $9.3 billion from $7.4 billion, also massive growth there. So Google advertising, including YouTube as a whole, was at $61.2 billion this quarter, up from $46.1 billion in 2020 in the fourth quarter, so massive growth across that board. Google's other business at $8.1 billion, so growing extremely well versus the $6.6 billion a year ago in the same quarter. When it comes to Google Cloud, which is becoming a massive business for Google, this quarter was at $5.5 billion, huge growth against the $3.8 billion a year ago in the same quarter. On the Other Bets segment, we're at 181 million, so this is still a very small business for Google. In comparison, a year ago it was 196 billion, so it's not great to see that the revenue did decrease year over year in the Other Bets segment, especially since the Other Bets segment includes things like Waymo and all these futuristic bets that Google is placing in the future, or I should say Alphabet is. And that type of revenue obviously is going to be extremely small today, but it's what presents huge opportunity for the future. So it would be nice to see some progress in the Other Bets segment. That said, those are extremely long moonshot type of ideas, And I think it makes sense that it will fluctuate increased growth and decreased growth randomly for that segment. Now, total revenues did hit 75.3 billion in the quarter, like we said before, huge growth against the 56.8 billion a year ago. And as far as number of employees, they've went up to 156,500 employees, up from 135,000. Now, the individual businesses' operating income, as far as Google services, including ads, etc., we're at $25.9 billion for the quarter in operating income. This is up from $19 billion a year ago. The Google Cloud business had a loss of $890 million, but this is significant improvement versus a loss of $1.2 billion a year ago. So the business is getting better. The other bets segment did have an increased loss at $1.45 billion versus a loss of $1.136 billion a year ago in the same quarter. So it is losing more than it was before. Now, moving on from the income, two things that they brought up in this earnings report. The first is the change in the useful lives of our servers and network equipment. So they discuss how basically they completed an assessment of how long the servers and network equipment lifespan would be, and they adjusted it for their servers from 3 years to 4 years, and they estimated that the network equipment could go from 3 years to 5 years of lifespan. Now, this change in accounting is going to be effective beginning fiscal year 2021, and the effect for the 3 and 12 months ended December 31st, respectively, was a reduction in the depreciation expense of 446 million and 2.6 billion, and an increase in net income of 347 million and 2 billion. So what's happening here is instead of writing off these expenses over 3 years, for example, and changing it to, let's say, 5 years, they're only going to write off less per year, which makes their total net income increase since you have less of an expense in the year. So although it doesn't really mean much, they're still paying the same price for the equipment, and they're still going to make just as much revenue as they were making. Accounting wise, it does change the numbers slightly. And lastly, we bring up the big stock split that we talked about in the title page of this video. So stock split affected in the form of a stock dividend. Alphabet announced today the board of directors approved and declared a 20-for-1 stock split in the form of a one-time special stock dividend on each share of the company's Class A, Class B, and Class C stock. The stock split is subject to stockholder approval, and the amendment to the company's amended and restated certificate of incorporation to increase the number of authorized shares of Class A, Class B, and Class C stock to accommodate the stock split. If approval is obtained, each of the company's stockholders of record at the close of business on July 1st, 2022, the record date, will receive after the close of business on July 15th, 2022, a dividend of 19 additional shares of the same class of stock for every share held by such stockholder as of record date. So let's break this down. To be clear, to anyone unfamiliar how a stock split works, it does not technically make any difference to the valuation of Alphabet. The share price is going to get divided by 20 when the stock splits 20-1. So the amount of total shares in existence is going to be 20 times what it is today, the outstanding shares, and your price of your stock is going to go into 1/20th per share. So just to give you an idea of how this would work, if the stock was currently $20 and they did a 20-1 stock split, instead of one share for $20, you'll have 20 shares that are each $1. At the end of the day, it's the exact same thing. That said, I can't tell you how many times I've spoke to a random person about stocks that doesn't understand how stock splits work, and they told me they plan to buy a stock like Apple or Tesla in the past when they had announcements of stock splits. And they always use the reason as it's going to be more affordable in quotations. And that is because that is a misconception. It is not more affordable. A lower share price has absolutely nothing to do with affordability since there is commission-free trading with most brokerage platforms nowadays, and there's also fractional shares. Because these two things exist, it is not any difference in affordability. If you invest $10 into Alphabet today, or you invest $10 into Alphabet stock post-split, it's going to be the exact same thing. You are investing based on its valuation, its market cap. A share price on its own means nothing. The only time a share price matters is when you're looking at share price and total shares that exist, outstanding shares. Those two things combined is what tells you the market cap and the valuation you're currently investing in. And even the market cap alone is not always just an easy thing to look at because the company could have debt. So sometimes you want to look at the enterprise value. And then there's the growth. Is it decelerating or accelerating? So valuing a business and deciding to invest if something is affordable or if something is cheap, it's a lot more complicated than just looking at a share price. And this is something that many retail investors still don't understand. So what ends up happening is even though this means nothing, because they're going to do a stock split and their price of the share is going to go down, and since there's such a massive retail investor base participating in the markets nowadays versus the past, a stock split seems to add some type of value to any stock that does one. Now, of course, it's not actually adding any value, but if enough retail investors don't know the difference or think, hey, I'd rather own a full share than a fractional share, so they start buying because of the stock split, just due to supply and demand, it can give the stock a little bit of a push. Now, with companies as big as Alphabet, the push is not that much and it shouldn't really make much of a difference. But there's a huge retail investor base and you never know what can happen with these type of things. So, if anything, I think it's a positive. Lastly, Google also might just be looking to get itself in the Dow Jones. Apple did this when they split their stock to get in the $100 ish range, and it's because the Dow Jones is actually a price weighted index. So adjusting to a $100 to $200 range for their share price actually would help it get into the Dow if they were looking to do that. But that's for a different topic, and I'm not sure that's their plan, anyways. So, how did the stock react to earnings? Well, obviously, these earnings were awesome, and in after hours, this stock was up over 9%. It was up on the day $43.60, but then in after hours, they went up another $252.98, an extra 9.17% to bring the stock over $3,000 to $3,010.55 at the closing of after hours. So this is pretty close to the 52-week high of like $3,030 or so. We could see a new all-time high tomorrow if it keeps up this gain and goes a little bit more. As far as valuation at these prices, Alphabet had a 41% revenue growth rate in 2021 year over year versus 2020. The market cap is almost $2 trillion dollars and it trades around 27 times earnings. It's incredible that Alphabet is able to grow revenue at such an incredibly high percentage and also have accelerating growth rates at these levels. So 27 times earnings for a company with this type of growth at this stage is a fair price in my opinion. I think with the moat that Google has on search and the growth ahead, you can even justify maybe a 30 times multiple on their earnings. But I have recently said I believe Meta Platforms is the most undervalued big tech company. And I think Alphabet is second to Meta as far as valuation. I believe Alphabet represents the best value after Meta when you're looking at big tech and comparing it to Apple, Microsoft, or Amazon nowadays. But with the move in the stock price and after hours going up 10% or so, I wouldn't be rushing to buy any shares at this price. It is trading at an all time high, and even though I think they are justified at this value, I wouldn't sell the stock if you're holding it. I wouldn't be adding when you have the ability to buy companies like Meta, which are trading at much lower price to earnings, have insane high growth as well. And Meta actually is going to have its earnings report after hours, Wednesday, February 2nd. You might be listening to this right before Meta earnings come out. I'm recording this obviously Tuesday night, February 1st, when the Google earnings came out. So I personally prefer Meta stock, especially after the jump in the price on Alphabet, but I think they're both great companies. I think it is trading at a fair valuation. It is totally justified with the growth and the moat and all the opportunities ahead in the others business that they're creating. They invest in so many startups. Google is a massive conglomerate across the board. Now, I do want to bring up Meta because when any company in big tech does well on earnings, it affects the rest of big tech. So they have all had amazing earnings, big tech, Microsoft, Apple, Google, and I expect Meta Platforms is going to be no different, especially since Alphabet is the closest big tech company we can get to measure how well Meta will do since they're both in the advertising business. So, with the huge quarter for Google ads, I'm expecting Facebook to do very well, or Meta, I should say, with Facebook ads and Instagram ads. And the market is probably expecting it as well because these Google earnings, these Alphabet earnings, shooting the stock up almost 10%, has pushed Meta Platforms up 3.45% in after hours to $330 a share. They closed up 1.8% at 319 a share, but they got pushed up when Google reported great earnings. So I believe Meta is going to also report great earnings. I wouldn't be surprised to see just as big of a jump for Meta because it is trading at an even lower price to earnings than Alphabet was before Alphabet reported earnings. So I wouldn't even be surprised to see a greater than 10% return on earnings. That said, I'm in it for the long run. I'm holding stock. I'm holding 2024 calls. I believe in Meta for the long run. Do you own any Alphabet? Did you own it going into the earnings? Are you holding Meta Platforms going into its earnings? If you don't have Meta, do you plan to buy it before these earnings come out? Are you going to buy it after earnings? What are you looking for? Comment below. Let me know what you think about these companies. If you have any questions, drop it in the comments. I'll be happy to answer. And if you made it to the end, please like the video. Subscribe to the channel if you haven't subscribed already. Until next time.